Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Friday. It's February 11th. Don't ask me where February is going. Don't ask me where 2022 is going. I'm still trying to figure out where 2021 went. It's about 7:51 in the morning. The market's going to open up in about, an hour and 39 minutes, if my math is still correct. As you can see here, we're not doing so good. And what I mean by not doing so good, or so well, if I want to use proper English terminology, it's Friday. Want to be fancy on Friday. But as you can see here, the Nasdaq's down, the Dow's down. But overall, this isn't anything too bad. But if you consider that the market dumped 500 points yesterday and it's not showing any kind of a bounce, it is fairly significant. Looking at the chart of the Dow, we're still okay. And I'm saying that in a very, very cautious way. We're still okay because we're still sitting above the 200-day moving average. But I'm going to tell you right now, if we come off those levels, things are not going to be pretty. The S&P, let me show you the S&P real quick. And I mean, this is after a decline of 500 points. The S&P is already down a hair. And again, we're still above the 200-day moving average. So I'm very happy about that. The QQQ, on the other hand, well, not doing as well. The QQQ is trading below the 200-day moving average, and it looks like it's breaching this violation. So if we don't see an upside today, there's a good chance we're going to be going back down, which is why I initiated those short positions in 3 of the services last week. Also, bond market, I think bond market is going to get a little bit of a reprieve. We are deep overdone right now. And also, another factor I wanted to show you is momentum levels. If you look at momentum levels on the NASDAQ 100, we kind of went back down, but they're still relatively stable. Look at that. They're still relatively stable. So there's still a good chance we're going to go up from this rally. And it doesn't look like we're going to go back down after hitting this low. It looks like we bottomed out here. So it looks to me like we can have a rough road, but we are moving in the right direction. If we come back down after this from here, we're going to stay here for a while. But typically, as you could see here, every time we come down to these levels, even right here, we come down and then we come back up. We had a little hiccup here, came down and came back up. But I'm going to tell you right now, we're near lows. We're not near the highs. So don't start thinking that the market's going to crash from these levels, because even if it does, it's going to go from 26% to 10%. So 10 stocks are going to go below the 200-day moving average in the NASDAQ 100, whereas there's 100 stocks. So, and looking at it longer term, as you can see here, it looks like we're bouncing off. Just like we did on these levels. Let me go to a 10-year chart. Again, it looks like we're bouncing off. So I would definitely like to keep the long exposure here. And also volatility, although it is going higher, it's not blowing up or anything like that. That's because it's used to the current momentum levels. I mean, we're not seeing anything weird. But if we break today's low, we are going to go above these levels. So it's Friday. We got to be very, 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 very cautious today. Yesterday, we had CPI and came out better than expected or hotter than expected, which showed us and proved that inflation is at the hottest level in 40 years. Today we have consumer sentiment. Now, this isn't such a big report on its own, but it does reflect retail sales. So keep your eye on this report. It's coming out at 10 a.m. and it may impact the market. Yesterday we had the CPI, excuse me, and that came out really, really hot and kind of put Fed in a corner to take action. What was interesting about the report yesterday, though, was the market didn't initially react. The market reacted like an hour later. It actually started going higher and then broke down, which kind of tells me that most of this is priced into the market. Let's talk a little bit about news, and then I'll talk about current levels. World shares declined Friday after a sell-off on Wall Street, spurred by news that inflation in the U.S. jumped 7.5% in January. That was the CPI report that I was just talking about right here. S&P sank 1.8% on Thursday, and it's even down right now. On the reports, inflation was the hottest since 1982. Do you guys remember 1982? It was a crazy year. Bond yields jumped as traders bet that Fed may have to apply brakes to the economy with a bigger than usual hike in interest rates next month. Don't hold your breath for that. The yield on the 10-year Treasury topped 2% for the first time since 2019. That's why I don't want to go against the long-term trend on bonds, and I only want to short. Other economies are also feeling the heat. with some central banks already moving to raising interest rates. Others are holding off. Central banks in Thailand, Indonesia, India, not huge financial capitals, opted this week to keep their benchmark rates unchanged. And guess what? I have a feeling that the Fed is going to do the same. I think they're playing chicken, and I think they're looking for every reason not to take action because they know how that'll derail the stock market. Trading has been volatile this year as investors puzzle over how quickly and by how much the Fed will raise rates. The benchmark has fallen 3 out of the last 5 weeks and is now 6.1% below the all-time high set in Jan. Inflation has been building as the economy rode back from the pandemic, but supply shortages, snagging global supply chains, COVID, blah, 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 and prices at the consumer levels were up 7.5%. What are you going to do? Rising rates could help rein inflation, but at the cost of putting pressure on stocks and cryptocurrencies. But here's what I'm going to tell you, folks. Stocks follow earnings trends, and earnings trends have been way better than expected. The top 5 stocks, Alphabet, Google, Amazon, Facebook didn't do well, but overall, they're up like 25%. So the numbers are a lot better than expected. And again, volatility is not really going back up to where it is. So I think volatility is pricing in. And I also think the bond market has bottomed at these levels. I don't think the bond market's going to go much lower. I think it's pricing in the rate hike. Matter of fact, we lost 1.59% yesterday. Pre-open, we're already up half of that. Pre-open. So I think the market is going to bounce today. But Mondays are usually a down day, so we got to be very cautious. It's no excuse, but it's been the toughest market I've seen in ages. Looking at each sector, here is the pain points, guys, and I've mentioned this before, and I'm going to mention it again. We got to take out this high. If we don't take out this high, the 190 high, we're not in a good shape. We took it out yesterday and went back in, but the highs are looking good and the lows aren't looking that bad. So if we can reclaim some of this today, we would be in a much better shape. But look for a 190.3 level on consumer discretionary. And on tech, look at communication services in the crapper. But on tech, where's tech? Look at the 164.50-ish level. If we can break above that, we would do pretty good. We did have a little breakout yesterday, and it was positive, but we curled back down. If you look at the QQQ, let me give you those levels real quick here. The level we need to break on the QQQ is right here. It's the 200-day moving average. It's the 367 level. And it'd be better if we broke the 370 level. If we can break the 370 level, there's a really good chance. First, we'll be above the 200-day moving average, but then there's a really good chance we'll go above the 50-day because this will squeeze out a lot of shorts. There's a lot of shorts right now that'll be squeezed out of their position. And I think that'll happen because a lot of hedge funds have been shorting the market over the last several weeks. Now, this week hasn't been such a bad week. We shorted Intel late last week when it went down. We got in on 2.2, which is right here, right there. And we bought a put for, we held the stock for 2 days literally. We got in here and we got out right there. So in here, out here, made a nice juicy 21.67%. Then we finally took profit on our MGM position. We got in, let me show you where we got in on this one, 113. Let's see. 113 right here. We rode it through because I knew that COVID's going to decline and the fun is going to start up again. And we got out right, let me show you this, 2-4, right there. Got out right there. It would have been great if we held it for 2 more days, but we held it all the way through this and got out with a juicy 25.7% profit. We did have it for 27 days, but still not too bad. But I think MGM is now coming off a little bit. We got to be very cautious right now. Next week, here's what I'm going to tell you right now. I'm going to show you right now. The biggest factor that's going to drive this market next week. We need to see the Dow Jones break above the 50-day moving average, which is at 35,500 level or 35,600 level. That's what we need. We need consumer discretionary stocks. I know I'm singing the same song, but this is what's relevant. We need to see consumer discretionary break above 190.22, and we need the SPY. We need the SPY to break above right above the 460 level. If we can do that, we can get a really, really good rally. Now, before I let you go, and folks, I hope I've been keeping you or helping you stay out of trouble with this market. If I have, send me an email, support@marketgeeks.com. Love to hear from you. But as you know, I'm not a huge fan of trading gaps, right? I've never been big on gaps. It's just not my cup of tea. But the way the market is laid out right now, this style of trading could be imperative. And I mean imperative to your success. And I know one gap expert who has seen these setups and she's got these setups down to a science. Folks, you have to meet this gap master. I like that, gap master. I've never seen this level of expertise before. It's really, really cool. And with this volatility, there's gaps happening all over the place, even in the major indices. It's time to take advantage of it. And I want you to trust me. Yes, trust me. Being one of the first to know about the secret trader could be a huge value for you. All right? I mean this. I'm not just sitting here at 8 o'clock in the morning whistling Dixie. I really mean this. Trust me. Being one of the first to know about the secret trader could be a huge added value for you. And I'm bringing her to you next week. Click the link below to sign up for this awesome opportunity and training. It won't cost you anything, and everything else coming up next week. And next Monday, we're going to talk about weekly outlook, biggest threats, biggest opportunities. With the markets being crazy right now like they are, you need to keep an eye on these videos. Follow the link below. There's a link in the YouTube Wealth Press channel below this video if you can't seem to find a link. And send me an email. It's Friday. I want to know if I've been helping you navigate this crazy market. I've been telling you the market's going to go nuts, and there it is. And I've been telling you to increase your short position, and volatility is going to go higher. But we got key levels. If we can break above these levels, we're going to look good. Don't let this volatility scare your pants off. Have a great, great weekend. Bye. Follow the link below. You're going to love her. I mean, you're going to love her. Bye.